the IRS has blessed us with this opportunity to defer taxes, right? But they sure don't make it easy. And so when you sell real estate, in order to defer all taxes, you need to buy real estate of equal or greater value.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. I'm so glad you're here with us today. I've got another amazing guest, Ben Carmona. Ben, welcome to the show.
Thank you, Jeremy. Appreciate it. Good to be here.
Yeah, absolutely. And I'm really excited to have you on the show today, Ben. Why? Because I would say of my listening audience community, the number one question that I get from the community is, can you talk to me more about a 1031 exchange, right? They're either individuals that maybe have single family rental homes, or maybe they took over their parents' single family home, or maybe they're a passive limited partner investor in a real estate syndication. It's just a question that comes up a lot. So I know there's a lot to unpack here, when it comes to 1031 exchange, both the lazy and the traditional and the Delaware Statutory Trust and the TIC structure and all these kind of acronyms, right? So maybe you can kind of, before we, dive deep into the weeds, maybe you can kind of give our listening audience a little bit more information about kind of your background, your story, your journey, et cetera.
Sure, absolutely. Be happy to. Thank you, Jeremy. So I'm based in Orange County. My office is in San Juan Capistrano. I'm married. I have two young kids, 7-year-old son, 5-year-old daughter. And my whole my experience really lies in the real estate investment finance world. And really right out of school, I got involved on the alternative investment space, if you will. So these are alternative investments, by and large, investments that are outside of mainstream, stocks, bonds, annuities, so on and so forth. And I spent about 15 years on the investment syndication side of the business. So acquiring real estate, doing the underwriting and due diligence, structuring all sorts of private real estate vehicles, be it Delaware Statutory Trusts or tenant common or TICs, private REITs, business development companies, funds, you name it. I've kind of been involved in it. And then also educating financial advisors, wealth managers, CPAs, attorneys nationwide. I mean, so that this is my this is really I'm not great at many things, but I do know this space pretty darn well. And I took that knowledge and information that I gathered over the years, and I ended up jumping the fence, if you will, and starting my company, Perch Wealth, to advise and represent clients on the very investments that I had built for so many years.
Yeah, it makes total sense, and I appreciate that. I'd like to just kind of, maybe start eating this elephant one bite at a time. So maybe you can kind of explain for our listening audience a little bit more about, how does a 1031 exchange work, and how can it help real estate investors defer capital gains taxes?
Right. 1031 exchange is the most powerful tax code, if you will, in the books. They've been around for 100 years, right? And it essentially allows investment property owners to sell their investment properties and defer paying tax on the gains as long as they take the proceeds from the sale and exchange into other investment property. Of course, there are rules and guidelines that need to be followed. One of the big ones is you need to buy equal to, if not more, real estate when you sell your property, you need to buy at least the same amount of real estate that relative to the property that you sold. So if you sold the property for $2 million, you need to buy at least $2 million, and that requires you to exchange the proceeds from sale. And if you had leverage, assume equal to, if not more. It's a 1031 exchange, or one of the slogans, if you will, swap till you drop, right? You exchange and exchange and exchange, or swap, and then one day you pass away, and your beneficiaries get the benefit of the stepped up cost basis. So all the taxes that have been deferred over the years, they go away. And that's why, again, the 1031 exchange is such a powerful tax mitigator, because it's the only tax code out there that allows you to defer until you pass, and never have to pay those taxes as long as you continue to exchange.
Yeah, you gave me a lot of things to kind of unpack there, I think, and I'll kind of follow up with you on some questions here. But so in a 1031 exchange, you have this like property that you're selling, right, or exiting, which I believe they call the relinquished property, right? And then you've got this next property that you're going to 1031 exchange into, which would be maybe called the replacement property. You need to own both the relinquished property and the replacement property under the same ownership, and you also have to own. You have to be an owner of the replacement property as a direct owner, right? Most of our listening audience are not direct owners in the replacement property. Rather, they're limited partner passive investors, where they're of course acquiring shares, of the company that owns that entity. So maybe you can kind of unpack for our listening audience a little bit more about why, in that type of an exchange, when you're 1031ing into another operator or another syndication firm's deal as a limited partner, why you can't get limited partner shares, why you actually have to own direct ownership in the replacement property, and then why that then thus requires you to set up a DST, with that tenant in common agreement.
Right. Yeah. So, no, it's a great question, and often something that's misunderstood. Yeah. In order to do a 1031 exchange, you need to be an owner of the real estate, right? You see in the code, like kind. And so, if you're just a limited partner in a partnership, you own an interest in a deal, or in a piece of real estate. You're not directly an owner of that in that partnership, right? And so you would not be eligible to do a 1031 exchange. Now, with that said, there are plenty of clients that we work with that own property in the name of a partnership, right? So if you and several others are part of the partnership that owns a piece of real estate that you're on title, and you sell that real estate, the partnership itself can do an exchange, right? But if you just simply, again, have an ownership interest in an LP, or if you own shares of a REIT, you're not a direct owner of that real estate. Those would not be eligible for 1031 exchange purposes.
Yeah, that makes total sense. So, a couple of questions. Number one, why Delaware? And does that Delaware Statutory Trust, the DST, does that entity that's required to be established with a 1031, does that entity effectively act as a pass through? Meaning you've got the investor who is bringing the 1031 exchange money into, that then thus has a TIC agreement with the DST and the main operator, right? Which the management or the operating agreement of that management entities are effectively the same. So that DST is effectively acting as a pass through into the main investment. A large part of that, I believe, is because the banks or the lender, the senior lender, could get a little bit of heartburn knowing that there's this 1031 exchange investor that now has direct ownership and could potentially stop a sale, right? Or could potentially make some decisions relative to the property that aren't good for all investors in that deal. Am I kind of framing that correctly?
Let me try to. Yeah, yes. I mean, we touched on it several different things. first, so the DST structure is a 1031 eligible structure. The TIC structure is also 1031 eligible, but they're different. And before I even get into those, I do want to say, like, a traditional 1031 exchange, right? Forget about the DST and the TICs for a second. A traditional 1031 exchange, which are, the far the most common, right, that have been around for 100 years. It's you sell your investment property, you go out and find your replacement property, right, on your own. You sell your own property, you buy your own property on your own, right? That's still the most common way to do 1031 exchanges today. Now, if you the TIC and the DST, these structures are becoming more popular. It's really in line with, I would say, demographics, right? The majority of the aging of our population, really fueled by the baby boomer and the senior generations. And these are the folks that control the majority of the wealth in the country. And a lot of that wealth is in private real estate that they've aggregated and managed for 20 to 50 years. These folks, by and large, are tired, and they would love to know about a passive solution, right, that would allow them to sell their properties, defer paying taxes via 1031, get away from active management, and get into something that's income producing but passive in nature. No burden of management. So that gets us to I'll just start with the Delaware Statutory Trust. DSTs were created in the 80s. They weren't set up for 1031 purposes, but it's a structure where you have one trustee that manages the trust on behalf of up to 499 beneficial owners, right? So when you apply this DST or this entity or trust to real estate, it creates a situation where there's fractionalized ownership. You can have a lot of investors come in and invest and own one large property, right? And with the DST, I don't want to get too complicated here, Jeremy. Yes, so the DSTs, Delaware Statutory Trust, in my world, there's 50, 60 different Delaware Statutory Trusts, which essentially are institutional quality properties. It could be a $100 million multifamily in Dallas, Texas. It could be a $50 million self-storage portfolio in Raleigh, North Carolina. Bottom line is they are institutional quality real estate. These are properties that are already acquired and owned. Some of them are financed, some of them that are not. They're stabilized and income producing. And so for some of your listeners, essentially it's a turnkey 1031 exchange solution or investment. Hopefully that was a lot I just spit out there. That's a DST in a nutshell. The TIC, which it just stands for tenant in common. Tenant in common is a form of ownership. Jeremy, you and I can own a property, as partners or as tenants in common. Essentially, it just allows us, if we sell that property, we can go our separate ways. In my world, in the syndicated world, it's another passive structure for folks, but there's far less than 499 investors can invest in a TIC. It's really up to 35 tenant in common owners, and there's other structural differences. But I'll stop there.
Yeah, Benjamin, there's a reason why I get so many questions about 1031 exchanges, and there's a reason why I wanted to have you on the podcast. I recently published a book called The Fundamental Investor, and I actually dedicate half a chapter to 1031, but certainly didn't go quite this in depth. So I would like to take this opportunity now to talk a little bit more about kind of like the eligibility and the rules, right? And what are the key requirements and maybe timelines that investors need to meet to successfully execute a 1031 exchange?
Yeah, Jerry, and that's really the big thing today. Yes, we have this. The IRS has blessed us with this opportunity to defer taxes, right? But they sure don't make it easy, right? And so I touched on it on the front end, maybe in not the cleanest manner, but when you sell real estate, in order to defer all taxes, you need to buy real estate of equal or greater value, right? You sell $1 million property, you have to buy a property of at least $1 million. You could buy more, but if you buy less, right? Let's say you sell that million, you buy 900,000. you're going to pay tax on the difference. Right? The next thing is in order, there are rules that you need to satisfy. The big one, which most folks have probably heard about, they may not be too familiar, is you have 45 days from the close of escrow on the sale of your property to identify suitable replacement properties, right? So 45 days. If you intend to do a 1031 exchange, you sell your property, from that date, you have 45 days to identify potential replacement properties. Within that 45-day period of time, you can change your identifications as many times as you want, right? But once that 45-day period lapses, the properties that you have identified, which will be done through your qualified intermediary, and we can go into that if you'd like, Jeremy, those are the only options that you have to go into. So, under the traditional exchange, think about it. You identify, hey, I like these 3 properties. Well, you have to go out, you have to do your due diligence, your underwriting. You got to make sure everything flows smoothly. You can get your financing, everything checks out. The seller is cooperating. As we all know, that those things don't always align, right? So, if you're past your 45th day, you've identified 3 properties, 2 of them fall out of contract. I mean, you're out of luck, right? You're going to probably be paying tax if on at least in some portion. So I mean, those are the two big things. I mean, you have to buy equal to, if not more, real estate, and you need to satisfy the 45-day period. Once you have identified, you have 135 days post that identification period to close on your real estate. So as the rule states, 45 days to ID, 180 days to close on those properties. And so those are the 2 big components of a 1031 exchange.
Yeah, I mean, you're obviously highlighting something important, and that is, time is most certainly of the essence here. And, the second side of that is really, I think, about the potential risks. We talk about, the primary benefits, the 1031 exchange, but there are risks. One risk being you don't have a replacement property, and maybe you don't want to deploy that capital into a bad deal or with a bad sponsor, right?
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
So let's maybe talk through what some of the potential risks are, with investing in a DST through a 1031 exchange.
Right. Absolutely. So, and I'll just briefly marry the 2. We talked about these rules, right? And these guidelines that need to be followed to execute and complete a 1031 exchange. And the stars having to align, or I don't want to say the stars, but many things having to come together to complete that exchange. In the case of going back to the DSTs, or in some cases TICs, right? Again, these are turnkey real estate properties that are already acquired. They're already owned. Their due diligence and the underwriting has been done. Some of them are financed, some of them are not. And so they're there. You can sell your property and exchange into them immediately and start collecting income, defer your taxes, of course, so on and so forth. So that's moving to your question, Jeremy. For folks that are, that's appealing, right? They want to move away from active to passive management. Or for some of your folks, the younger folks, it's not ideal. They don't want to be passive, but they simply cannot find replacement property. That's where the DSTs and TICs can come into play. But when you get to that point, there's a whole world of investment options out there, right? And I'll tell you, I mean, there's 55 and growing active sponsors being those real estate companies that are structuring or syndicating these offerings. And of those sponsors, they have 100 different deals out in the market at any given time, we'll call it. How do you, or anybody for that matter, assess or underwrite the validity of each of these deals? And that is where it's very, very difficult, right? They all look wonderful. They look beautiful. You get these big kits, and you're like, wow, these are all amazing, and they're not, right? And that's really the value that we bring our clients. I spent 15 years doing exactly this. So of the 100 deals out there, I can almost immediately lop off 70 of the 100. Like, because I know the sponsors, I know the CEOs on down at these sponsors, I know how they've treated investors in good or bad times over the years. I know the fee structures, so on and so forth. And that's really what's most that's so critical, right? Because you walk into this world, and I don't care if you're the most sophisticated real estate investor or CPA or attorney, this is a whole different world. You don't know how to evaluate, and that's where my company gets involved and really provide guides investors, provides informed, objective advice, and keeps them away from the reduces risk by keeping away from the bad actors, if you will, steering them toward the stronger opportunities. And the last thing I'll say, Jeremy, I promise I'll shut up, is I don't have a crystal ball, right? There's risk in everything. We can absolutely mitigate it, but we don't know what we don't know. And I just want to throw that out there because that's important.
Yeah, no, I appreciate you saying that, and you're exactly right. I do have a crystal ball, but every day it gets a little bit more fuzzy. So, and then of course you never know what the next black swan event's going to be. But you highlighted something incredibly powerful, and that is, again, it's really selecting the right operator, right? There's operators in the game today that are 2 men in a truck. There's operators out there that have a team of 20, but they're not vertically integrated. Or you've got guys out there that are running teams of 300 with full integration. They can control, every aspect of the, business plan from acquisition all the way through disposition. So it's really nice to know somebody like you. I think every investor should have somebody like Ben in their toolbox to be able to reach out to bounce different ideas off of, at least as it relates to, which operators are truly best in class in the market. My next kind of question, Ben, and this is really kind of the softball question, and that is, how can investors use 1031 exchanges to build generational wealth, and what role does estate planning play into that strategy?
Sure. That is a softball that could go 1,000 different directions, Jeremy. But it goes back to, I think, where we started. This is the 1031 exchange is again the most powerful generational wealth opportunity out there, right? It's the only opportunity in the tax code that allows you to never pay taxes, right? There's so many investment strategies out there that you can defer, and then at some point you have to pay tax. In case of a 1031, that is not the case. If you, again, continue to exchange and you pass away, you get the step up in basis. That alone is incredibly powerful, and one of the reasons why so many investors and wealthy investors in the country are in real estate, right? It's not only the tax sheltered or the tax advantage income from the appreciation of the real estate, but it's just this ability to defer, and then wipe out. That is what's most powerful on the.
Makes sense. I also want to just ask kind of an elementary question. Most of the investment opportunities that I've deployed my own capital into, which is currently 32 as a limited partner investor, if I was to participate in a 1031 exchange, as a limited partner investor, maybe the sponsor that I'm with, is going to assist me in that process, or maybe I'm going to, pull that, capital cash off the table and go invest it into another sponsor's deal. Assuming I'm able to structure it the right way with the timing, et cetera. When it comes to the 1031 exchange, am I exchanging the original capital plus the equity profit split into the replacement property, or is it those two amounts plus the distributions that I also will have potentially received over the course of that investment hold period, or are those monthly or quarterly distributions not going to be a part of that exchange?
Yeah. Okay, good question. So if the exchange, the assets as part of the exchange will be the initial equity invested, of course, and then any appreciation, those components would be exchanged. The income received on a monthly or quarterly basis along the way, that's not a part of the equation. And I'll just, the caveat is if you're receiving income along the way and you're benefiting from or depreciation, right, sheltering income, that will lower your cost basis, of course, along the way, and that cost basis is relevant to the next exchange. But simply put, just the initial investment plus any appreciation, those would be the dollars rolling. The income would not be a factor in an exchange.
Yeah, it makes total sense. You want to continue there, Ben?
Yeah, I was just gonna, I skipped over, I didn't address estate planning. That's a big thing today, right? Because there's this transfer of wealth, right? The baby boomers, again, seniors, they've done so well, they've advocated all this real estate. Some of their kids want to manage it, some of them don't want to manage it, some of them, the parents don't want them to have it. So there's so many ways. Estate planning is a huge component of what we do on our side of the business, and so it's very relevant. And the DSTs or the TICs, the passive syndications, are great vehicles that play into the overall estate planning package. And I'll leave it there.
Yeah, no, that makes sense. And I appreciate you kind of explaining that and clarifying. I do have another kind of question that's been eating away at my ankles here, and that is the smaller investor. So I'm speaking about that, 50,000, maybe that $100,000 investor. Maybe they're capable of deploying 50 or 100K into one, maybe two deals per year. And now it's time for that deal to go full cycle in 3 to 5 years. But there's not a lot of sponsors in the space that I'm aware of that are willing to take a 1031 exchange investor unless it's at least 250,000, and a lot of them it's a half a million or a million or more, right? So, with that investor, other than the step up in basis, when they die, to not sound too morbid here, but there's obviously the opportunity for that smaller investor to still be able to participate, but just not through a traditional 1031 exchange, but maybe more of a lazy or a quiet 1031. Can you kind of explain, that the benefit is not all lost? And would there be any opportunities for that smaller investor to still be able to participate in a traditional 1031 exchange if there's no sponsors out there that are willing to take such a small investment?
Yes. I first want to, before I answer that question, I just want to say, so all of the investors that we work with and the investments that we recommend, you need to be accredited, right? And accredited means you need to have a net worth of at least $1 million, excluding your personal residence, right? So that's criteria number one. For the investor that has, 50,000 or 100,000 or 150,000, again, the minimums on DSTs are very low by and large, right? Again, you have up to 499 investors per project, if you will. The minimums are typically 100, but we've done to help out clients, 50, 75, 100, so we can accommodate that for sure. But before I'm part of my process when we're talking to clients, if you may have a small exchange and it may make sense to defer the taxes and move forward, but we're also looking at it from, does it make sense? Is it best that you just pay the tax and just keep the cash, right? So we evaluate the whole situation, your whole financial situation, to make sure it makes sense for you. I don't want you to invest or exchange into something where you're better served just having the cash on hand. I don't know if I answered your question, Jeremy, but
yeah, it makes total sense to me. I mean, in my own personal experience, right, when I first got started investing as a limited partner investor, and I would exit out of a deal, I would just deploy that original capital and my equity profit into another deal in the same year that also produced, or had a cost seg study. Obviously the last few years we've had the benefit of bonus depreciation, right? So long as I was, investing in something else within that same calendar year that also, produced a passive depreciation loss on my K1, I was able to leverage, the passive loss on deal 2 to offset, the capital gains tax consequences on deal number 1, if that makes sense.
Yeah, absolutely. And you just brought up, if we have more time, I'll say it. What you'll find, I'm talking to investors every day, all day. And again, our clients, by and large, have owned real estate for 20, 30, 40, 50 years. They're earning between 1% and 3% income on current values today. They're also fully depreciated, so they have no cost basis. So they're paying 100% ordinary income tax on 1% to 3%. So they're netting, almost nothing. And that's a major, you brought up, depreciation or cost seg. That is so whether it's you or your parents, that's what it is today. And it makes all the sense in the world, or many times, I want to say, to sell that property and do a 1031 exchange, not only to increase the income, but to your point, you can replenish your depreciation bucket in several ways, so that not only you're earning more income, but you're also sheltering a lot more of the income that you're earning today. And that's where, again, the DSTs can be a tremendous solution for so many investors.
Ben, this has been a tremendous discussion. What would be maybe 1 or 2 different ways that our listening audience can connect with you to learn more about what you're up to?
Yeah, absolutely. It sounds crazy, but I give out my cell phone and my personal email. And so I'll do it again. My cell phone is 818-269-4972. My email address is Carmona, Carmona, at perchwealth.com. I'll just say I have a business partner who's a real estate attorney. We have 9 advisors on our team throughout the country. This is what we do all day, every day, and we'd be happy to speak to anybody to educate them on what we do and see if it's a fit for them.
That's great. Well, we will put your cell number as well as your website and email address and the notes for the episode today. Again, Ben, really appreciate the value that you've brought our listening audience.
Very much appreciate your time, Jeremy. Thank you for having me.
And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.